Gold is sitting at one of the most important decision points of the week. Price has aggressively expanded higher, swept liquidity, and now sits in a zone where institutions often decide whether to distribute or continue expansion. In this breakdown, we'll decode gold using pure price action, liquidity theory, and smart money concepts, exactly how institutional traders read the market. Starting from the 1-hour time frame, gold remains structurally bullish. Price formed a strong impulsive expansion from the 4,500 region and continued creating higher highs and higher lows. This 4,500 region is the institutional anchor point. Price aggressively rejected this level, signaling accumulation and the beginning of expansion. And after accumulation, price delivered a clean break of structure. This BOS confirms bullish intent as buyers gain full control. Notice how retracements are shallow. This tells us demand is absorbing every pullback. This leg is pure displacement. Institutions are repricing gold higher with strong inefficiency and minimal downside acceptance. Now focus here. Price printed fresh highs into the 4,765 region where external liquidity rests above prior highs. This final push higher is important because it often attracts breakout buyers right before distribution begins. Price is now reacting directly inside a higher time frame supply zone. This is where institutions may unload longs and engineer reversal liquidity. This high is labeled weak because liquidity is exposed above it. Weak highs are magnets until fully resolved. Notice rejection from the highs. This suggests early sell-side interest entering the market. Instead of continuation higher, price stalls below highs. This usually signals absorption rather than strength. Equal highs are now building intraday. This creates another buy-side liquidity pool institutions can later attack. Below current price, this large 1-hour demand zone remains untouched and becomes an attractive downside magnet. Institutionally, the narrative is simple. Price expanded aggressively, tapped premium supply, and now may rotate lower to rebalance inefficiency. If sellers gain control, the first obvious liquidity objective sits near 4,660 where prior lows and imbalance meet. Retail traders usually buy breakouts into highs. Institutions often need those buyers to fill their sell orders. So the 1-hour bias is bullish overall, but locally price is trading in premium and vulnerable to corrective downside. Now let's move to the 15-minute time frame and study what price is doing right now inside this higher time frame narrative. On the 15-minute chart, price is currently consolidating after a rejection from intraday supply. This smaller supply zone is where sellers recently defended price. Price swept local highs into supply, took liquidity, and instantly rotated lower. After the sweep, structure shifted internally with a clear change of character. Current candles show compression, smaller bodies, and reduced momentum. Equal lows are now forming underneath price. This is clear sell-side liquidity. Below equal lows sits fresh demand, likely serving as the first downside objective. Momentum is no longer impulsive upward. Instead, buyers appear absorbed every time price revisits supply. This looks like textbook distribution, range, liquidity engineering, and failed continuation. Institutions often trap breakout longs, absorb their orders, and then expand into resting sell-side liquidity. As long as supply remains respected, downside remains the path of least resistance. A clean reclaim above supply would invalidate immediate bearish structure. Price currently trades at equilibrium, waiting for liquidity resolution. This is where patient traders wait. No prediction, only reaction at key liquidity zones. The roadmap is clear. Raid liquidity, confirm structure, then expand. Let's break down the exact sell opportunity first. Ideal sell setup comes from a retracement back into intraday supply between 4,706 and 4,712. Wait for rejection, bearish engulfing, or lower high confirmation inside this zone. Stop loss should sit safely above 4,718, beyond liquidity and structural invalidation. First target is 4,688 where internal sell-side liquidity rests. Second target is 4,660 into 15-minute demand and 1-hour imbalance. This setup offers roughly 1 to 3 risk-reward, making it institutionally efficient. Logic is simple: liquidity sweep, supply reaction, internal weakness, and downside magnet. But if price breaks above supply aggressively, bearish setup is cancelled. Now let's discuss the bullish opportunity. Best buy opportunity sits inside demand between 4,655 and 4,665. Ideally, price first sweeps equal lows, taps demand, then prints bullish confirmation. Stop loss goes below 4,648, underneath demand and liquidity invalidation. First target is return to equilibrium near 4,695. Second target is retest of intraday supply at 4,708. This long setup offers nearly 1 to 2.8 reward relative to risk. The buy is not random. It aligns with higher time frame bullish structure and discounted pricing. Professional traders do not chase candles. They allow price to reach liquidity and let confirmation come to them. Always align lower time frame entries with higher time frame narrative. Context beats pattern recognition. Liquidity sweeps are most reliable during London and New York volatility windows. Gold is currently trapped between premium supply and nearby liquidity objectives. The next expansion will likely come after liquidity resolution. If you enjoy institutional chart breakdowns like this, subscribe now, and I'll see you in the next gold analysis.